Kalshi has announced a bold expansion into commodities, announcing a dedicated hub that promises new trading doors for investors and institutions. In an environment where inflation, supply shocks, and geopolitical risk keep headlines loud, practical access to commodity exposure matters more than ever. The platform's move signals a pivot from binary events to a broader, scalable suite that includes energy, metals, and agricultural markets. Retail traders seek hedges, while institutions crave liquidity and transparent pricing. As risk factors rise, a regulated, user-friendly exchange could reshape how people manage price risk, diversify portfolios, and learn futures markets in one place. Kalshi is converting its binary event market model into a broader commodities platform, adding a dedicated hub that aggregates contracts across energy, metals, and agricultural products. The expansion means users can trade not just weather or event outcomes, but actual price-based contracts tied to real-world benchmarks like Brent crude, copper, corn, and soybeans. Think of it as moving from a few isolated bets to a neighborhood with multiple shops, each offering standardized contracts, margin requirements, and regulated settlement. Regulators, liquidity providers, and market makers are watching closely as onboarding, risk controls, and listing standards set the pace for growth. To understand Kalshi's move, we trace the arc from the early days of event markets to today's commodity demand. Kalshi launched in 2019 as a regulated binary events exchange, offering outcomes like weather or election results. The big shift happened as institutions demanded real asset exposure with cleaner on-chain settlement and regulated oversight. Commodity trading has long lived on futures exchanges, with benchmarks like WTI, LME copper, and Chicago corn under daily pressure from supply chains, weather, and policy. The push for a centralized commodities hub echoes the digitization trend seen in equity markets, where accessible rails attract new capital. Initial market chatter shows growing interest in Kalshi-style ads, with improved liquidity signals and widening bid-ask spreads around key commodity benchmarks. Traders compare the move to the 2010s expansion of gold and oil ETFs, which drew retail money, then opened wide access through low fees and standardized contracts. Early data suggests more activity in energy spreads, metal price differentials, and weather-linked risk hedges embedded in the hub. Market makers have started quoting tighter spreads on select contracts, while risk dashboards emphasize margin discipline. If the hub gains velocity, volumes could shift from traditional futures pits to digital, regulated platforms with visible settlement. Big commodity producers and consumer brands stand to recalibrate pricing, hedging, and capital allocation as Kalshi expands. Energy majors, mining groups, and agribusinesses could gain more effective exposure through streamlined contracts, while banks and asset managers reorient risk budgets toward cleared markets. Retail investors may finally access transparent hedging tools without navigating opaque brokers, but they face learning curves and margin requirements. Exchanges see new competition for liquidity and data, prompting partnerships with custodians and fintechs. Public pension funds and sovereign wealth funds may pilot concrete hedges, and mom-and-pop traders could participate alongside hedge funds in a more level digital playing field. Broader macro forces shape Kalshi's commodities bet. Global growth margins, OPEC decisions, and sanctions play into price trajectories, making hedges more essential. Supply chain fragilities exposed by climate events, political risk, and energy transitions complicate forecasting. Inflation has cooled from peak levels, but remains a pervasive pressure on risk assets and cash flow. Central banks' policy paths influence volatility across crude, copper, and grains. The new hub could attract cross-border liquidity as institutions normalize regulated digital markets while lawmakers debate transparency, data rights, and risk controls. In a world of shifting trade partners, diversified exposure becomes a strategic shield. Smart money is watching liquidity metrics and onboarding speed. Large asset managers test exposure with small initial contracts, measuring bid-ask depth and settlement reliability before scaling. Hedge funds explore cross-asset hedges linking energy, metals, and currencies, treating Kalshi as a risk management layer rather than pure speculation. Banks assign risk capital to the hub, seeking data feeds, API access, and clearing relationships to incorporate prices into models. Retail traders respond with cautious optimism, attending webinars, trying demo accounts, and comparing fees against legacy futures routes. The balancing act is to preserve capital while learning a new, regulated market structure. Bear case risks center on execution, liquidity, and governance. If onboarding slows, price discovery could degrade, leaving wider spreads and slippage that discourage participation. Regulatory clarity remains evolving. A misstep on compliance could trigger clawbacks, fines, or forced delistings. Concentration of liquidity with a few market makers may create systemic risk, especially if portfolio hedges fail during shocks. Tech outages or cyber incidents could disable settlement rails, eroding trust. Overconfidence in a regulated digital hub might lure risky leverage and reckless positioning. Finally, macro shocks such as sudden trade wars or sanctions could overwhelm hedges and force abrupt shifts in collateral requirements. For retail investors, the lesson is preparation and discipline. Start with small, clearly defined positions and study contract specifications, margin rules, and settlement methods before committing real money. Use demo accounts or paper trades to understand bid-ask dynamics and price impact in volatile markets. Diversify across several contracts rather than chasing a single hot name. Track liquidity indicators and fee schedules to avoid hidden costs, and align participation with your risk tolerance and time horizon. Take advantage of educational resources from Kalshi and trusted brokers, while maintaining a transparent stop-loss and position sizing plan. Consistency beats bold bets every time. Market watchers look ahead to a more accessible, regulated path for commodity exposure, aided by Kalshi Hub listings and continuous product expansion. If the model proves resilient, expect increasing participation across institutions and individual traders who previously faced opaque pricing or friction in traditional venues. The combination of liquidity clarity and cross-asset hedging could shift capital toward risk-managed growth rather than speculative bets. Regulators and industry groups will test compliance governance and data sharing as the platform grows, while buyers and sellers adapt to a digitized, transparent price discovery cycle. If you found this valuable, subscribe to the Commodity Brief for weekly insights on alternative assets and commodities.